Hi, I'm Pattu from freefincal. Let's do a comparison of stocks versus gold versus bonds, SIP, and lump sum returns. And perhaps for the first time, the 20-year Sensex return is now lower than gold, and we'll also see a possible shift in the gold INR and Indian stock movements. First thing is to have a look at the price variation of Sensex total returns index, the government bonds, the GSEC, the what is known as the ISEC sovereign bond index, and the gold per troy ounce. So that's the gold is in green, the Sensex is in blue, and the sovereign bonds is in red. If you see such a graph somewhere plotted anywhere, Twitter is probably very common. Please don't start to assume things about this, because this is just one return data point. This entire graph has got only one data point. It tells you the return from an investment made here to the investment valued here. So that point to point return is what is shown here. The rolling returns for lump sum and SIP would be very different, and we'll have to investigate that. So first, let's start with lump sum returns. Maybe I should make this a touch bigger. That might be a little better to see for a thing. So that's the 5-year lump sum returns. Let me just make myself out of the way. There you go. Let me just change this around a little bit so you can see more of me. There you go. So that's the 5-year rolling returns. The white is the Sensex, the brown is the gold, and the green is the sovereign bond index. And notice that from the start of the last decade, you can see here an opposite movement. That is, when the gold did well, Sensex did poorly, and then for a short while they went down together, and then since 2015 onwards, Sensex did well and gold did poorly, and now the cycle is changing. This kind of variations I have seen before in S&P 500 and US gold in US dollars, even over a very long term. I will show you a graph below. But this kind of a variation for the first time I'm seeing in the Indian scenario, and I think this is because of a stabilization in the USD INR exchange rate. During much of the 90s and probably the early 2000s, the gold price was governed by only the exchange rate for us, and that has now stabilized, and now gold INR is now responding more sharply to gold USD, and that's probably why you are seeing this change. This is the 5-year returns, and you can see a similar opposite movement here. You can see the red is the gold. When gold is doing well, the green Sensex is doing poorly, and opposite happening, and the cycle shifting again. I've also shown data for 10 years, but over 10 years you can see that this is the lump sum returns for 10 years. You can see for most part the movement of gold and Sensex were together, and you can't have that that opposite cyclic kind of behavior in the 10-year data as yet. Probably from now on we will, I don't know. This is a 10-year SIP, something similar what I just said. I have also shown 15-year SIP. 15-year SIP, you can see that the Sensex has now dropped below the gold returns, and the 15-year SIP of Sensex is now below both bonds and gold, and the 20-year lump sum return of the Sensex is now well below the gold. Even if you take tax into account, I think the Sensex will not be able to outperform gold as on date. Now, many people have made a lot of comments, that's the 20-year data, saying no, you should not look at this. You're seeing when there is a graph, when there is a crash. Yeah, this is a crash, and people are actually experiencing this crash as we speak. Only people from AMCs and sales guys will talk about averaging performance. That's just garbage. You don't average performance because it's simply not possible. What you need to do as an investor is to look at the worst possible outcome and prepare yourself what you would do if you face that worst possible outcome. Otherwise, if you listen to these sales guys, you're basically leaving the fate of your investments to luck. If you want to do that, go ahead. But if you want to be a little more prudent, then you have to worry about the worst possible return and prepare for it. Now, I've talked about somebody in Asan said gold outperforms most of the time. Equity outperforms gold most of the time. This is completely untrue. Look at the US data. This is data for 20 years in the US. Where is gold? Where is the equity? There is S&P 500 outperforming gold all the time? No. That's not true at all. It's there are some times when gold did well. There are some times when S&P did well. So you can see that cyclic behavior. S&P 500 did well here. Gold did poorly here. And then the gold did again poorly here. S&P did well, and it fell down. Gold is now coming back into the area. So this kind of a opposite trend you can see in US stocks. Sorry, in the US scenario, but in the Indian scenario, if you look at, we don't really have long-term data, but if you actually look at 10-year data, this is the 10 year is the actual duration for which we have significant amount of data points. You can see here that gold INR has done several times 10-year returns of the Sensex has been comparable to that of gold. So you can't say Sensex always beats gold in the long term. That is not true for the Indian context. That is not true for the US context. I have done a much more detailed study of this for the US context in a previous article. I don't have the image now, but you can have a look at that. So you can't really say that. The point now is, my feeling is that for the first time ever, I think we are now seeing this opposite correlation between gold and stocks meaning Sensex. And does this mean we should have gold in the portfolio? Now the point now is, at this very time, this is the time for you to invest in equity, because now the 20-year SIP returns of equity are lower than that of gold and the gold. So that's the time for you to invest in equity. If you invest in gold now because gold is doing well, you are more or less guaranteed to not get good returns in future, at least for the short term. Now, so if you want to do something now, invest more in equity. But in general, it looks like, at least I have been looking at golds versus stocks versus bonds for a while now. In the previous all the previous times I have looked at it, there was not a compelling evidence to add gold in the portfolio because I could not see this opposite correlation. But for the first time now, since the last decade, I'm seeing this correlation at least over 5-year windows. So there is a case for adding gold in the portfolio. However, the practical management of that is extremely difficult. You will have 3 asset classes, you will have to rebalance, you have to gold is extremely volatile. There will be 5-year periods, even SIP, 5-year SIPs, 10-year SIPs can give you very poor returns in gold, and you will have to go through all that. And when the gold is giving poor returns, you have to book profit from a well-performing asset class and put it into gold. That kind of portfolio management is not possible by most people. They don't have the emotional clarity for all that. So it may not be suitable for most investors. Yes, you can use a multi-asset mutual fund which has got minimum 10% of exposure to all asset classes at all times. Gold and equity, they will bonds, they will change as per market conditions. But the point to remember is that the multi-asset fund should be the primary component in your portfolio. Otherwise, it will not make any difference. So that's what I wanted to say. You don't need to worry about Sensex returns falling below gold and so on. This is the right time for you to add more into equity. That much is sure. But my point here is probably the evidence for adding gold into the portfolio is becoming stronger now, because now the exchange effect has gone down and gold INR is now tracking gold USD more closely than it ever did in the past. I've talked about this before. I have a chart on golds, etc. and so on. So that's what I wanted to say in this video. If you have any questions or comments, please let me know. Catch you later. Bye-bye.